Beijing has just executed a maneuver that will fundamentally alter global economic dynamics for the foreseeable future. If you're not carefully monitoring what is happening at this very moment, you may eventually wonder how the entire landscape shifted so profoundly without anyone explaining it to you. We are witnessing a decision that American policymakers have dreaded for decades, an action that analysts in the nation's capital anticipated for years, and now China has finally pulled the trigger. It has unloaded massive quantities of American government debt. I realize that for many of you, this probably sounds like tedious financial jargon, the kind of thing that only matters to traders in Manhattan or bureaucrats at federal agencies. But let me be absolutely clear with you. What has just occurred is far more consequential than any recent electoral outcome, any political declaration, or any headline you have encountered in recent months. This represents a foundational shift in how worldwide economic influence operates, and the consequences will affect your livelihood, your career, your savings account, and your prospects, regardless of whether you choose to pay attention or not. Let me explain precisely what this involves and why you must care. For more than 5 decades, since Richard Nixon abandoned the gold standard in 1971, America has operated under a system that critical economists like myself have characterized as the exceptional privilege of the dollar. This is not an equitable arrangement, and it is not a structure built purely on productivity. It is a framework grounded in an enormous inherent advantage that permits the United States to consume far beyond its earnings, while much of the rest of the planet subsidizes that lifestyle. Here is the mechanism. America produces dollars. Those dollars are accepted universally as the world's reserve currency, meaning every country requires dollars to conduct international commerce, to acquire petroleum, to accumulate reserves, and to protect themselves during economic downturns. And because the globe needs dollars, America can generate this currency without experiencing immediate and obvious repercussions. Imagine having a money-creating device in your basement while every neighbor consents to treat that output as legitimate payment. Regardless of how much you produce, regardless of how irresponsible you are with your finances, you can perpetually create more currency and someone will accept it because everyone depends on that framework. Now envision this situation. One day, your biggest neighbor, the one managing the most successful enterprise in the vicinity, the one who has been accepting your manufactured currency for decades, suddenly declares, "You know something? I no longer want your currency. I am going to depend on something else. I will depend on precious metals. I will depend on my own money. I will transact directly with other neighbors without your involvement." That is essentially what China has just executed, and the implications are genuinely enormous. But to completely understand why this carries such weight, we must examine more thoroughly how this mechanism operates, and why it cannot persist indefinitely. I have dedicated my professional life to analyzing capitalism, its failures, and its inherent contradictions. And I can assure you that the current arrangement of the dollar, as the worldwide reserve currency, represents one of the most significant economic disparities in modern history. It enables the United States, a country comprising fewer than 5% of global inhabitants, to consume approximately 25% of planetary resources. How is this achievable? Because America can finance colossal trade deficits year after year, decade after decade, simply by manufacturing more dollars or marketing more dollar-denominated obligations that foreign nations acquire. Think about it this way. If you or I spent beyond our income every month, eventually our credit lines would max out, financial institutions would decline further lending, and we would encounter genuine monetary difficulties. But the United States has been spending in excess of its production for over 40 consecutive years, accumulating enormous trade imbalances. And rather than confronting swift consequences, the remainder of the world has continued financing that lifestyle by acquiring U.S. Treasury securities. China has historically been the largest overseas holder of these securities. At its zenith, China possessed over $1.3 trillion in U.S. Treasury instruments. That is $1.3 trillion. For perspective, that exceeds the entire gross domestic product of countries such as Mexico or Indonesia. Effectively, China was extending the United States' exceptionally substantial loans, and America was utilizing that borrowed capital to fund its expansive military infrastructure, to finance operations in regions like Iraq and Afghanistan to support tax cuts benefiting affluent individuals, and to provide bailouts to major corporations. So the obvious question emerges, why would China pursue this? Why would it finance its principal geopolitical competitor? And this is where many conventional explanations fall short. They will suggest it was a mutually advantageous relationship where both parties prospered. The United States obtained inexpensive financing for its deficits. China secured access to a vast marketplace for its products. Chinese laborers manufactured goods that American consumers purchased with borrowed capital. And that capital returned to China as dollars that the Chinese administration invested in Treasury securities. A supposedly virtuous cycle, they maintain. But that narrative obscures a crucial power dynamic. China lacked genuine alternatives. When a country generates substantial trade surpluses with America, it accumulates dollars, and those dollars must be deployed somewhere. You cannot simply allow them to remain idle. You must invest them. And for years, the largest, most liquid, and ostensibly most secure option was U.S. Treasury bonds. It was the sole market capacious enough to absorb the tremendous dollar flows China was generating. However, there existed a fundamental vulnerability in this configuration that China began recognizing more acutely over time. By maintaining such extensive reserves in U.S. Treasury securities, China was placing itself profoundly at the mercy of American financial authority. If Washington elected to freeze those assets, China could forfeit access to over $1 trillion of its sovereign wealth. If Washington opted to release enormous quantities of fresh dollars through accommodative monetary approaches, the real value of China's portfolio would diminish. If Washington decided to weaponize the financial apparatus for geopolitical objectives, something it has executed repeatedly against countries like Iran, Venezuela, Russia, and Afghanistan, China would be vulnerable. And here is the pivotal insight I want you to absorb. China observed meticulously what the United States executed against Russia following the conflict eruption in Ukraine in 2022. Washington immobilized approximately $300 billion of Russian central bank reserves. Consider that again. The United States and its allies effectively commandeered control of $300 billion in the foreign reserves of another sovereign nation. Irrespective of your stance on Russia or the Ukrainian conflict, this constituted a watershed moment in global financial history. It demonstrated unequivocally that dollar-denominated assets, even central bank reserves that are theoretically sacrosanct within the international financial architecture, can be frozen, withheld, and deployed as leverage if a nation defies American interests. Now position yourself in the mindset of strategists in Beijing. You hold $800 billion, until recently exceeding $1 trillion in U.S. Treasury bonds. You recognize the United States perceives you as its foremost strategic adversary. The Pentagon has explicitly designated China as its primary concern. The United States is constructing military coalitions across Asia specifically designed to constrain China's influence. It is imposing tariffs on Chinese merchandise, restricting technology transfers to China, and constantly discussing defending Taiwan militarily. And simultaneously, you possess $1 trillion of your national wealth that this same country can immobilize with a simple directive. What course would you pursue? The answer is evident. You would diminish your exposure, diversify your reserves, and seek alternatives. And that is precisely what China has been undertaking. Not precipitously, not chaotically, but methodically, purposefully, and systematically. Data from the U.S. Treasury Department illustrates this trajectory unmistakably. China has been liquidating U.S. Treasury bonds consistently for years. From over $1.3 trillion at its peak, its holdings have now declined to less than $800 billion. That represents a reduction exceeding $500 billion. $500 billion no longer underwriting America's deficit. $500 billion that China has redirected into alternative assets, different investments, and different stores of value. Recent data from October 2025 shows China's treasury holdings fell to approximately $688.7 billion, the lowest level in 17 years. And China is not isolated in this behavior. Japan, traditionally the second largest holder of American treasuries, is also reducing its positions. Saudi Arabia, the nation that formalized the petrodollar agreement with the United States in the 1970s, is diversifying its reserves and contemplating oil sales in yuan. Central banks globally are acquiring gold at unprecedented rates. Russia has liquidated virtually all its holdings of U.S. Treasury securities. India is stockpiling gold. Brazil is establishing trade agreements in local currencies. The entire infrastructure that maintained the dollar at the nucleus of international commerce is progressively eroding. And most individuals remain oblivious because mainstream media is preoccupied with covering some official social media post or the latest celebrity scandal. Now, let me preemptively address the arguments from defenders of the existing system. They will contend this is inconsequential. The United States will invariably locate purchasers for its bonds. The dollar is too entrenched to surrender its position. There exists no viable alternative. China would harm itself if it liquidated all its bonds because it would depress the value of its own portfolio. Superficially, these arguments might appear persuasive, but they disintegrate under even rudimentary scrutiny. First, the assertion that no substitute for the dollar exists. That was valid 2 decades ago. It is no longer accurate today. China has deliberately constructed alternatives to the dollar-dominated framework. It established CIPS, China's cross-border interbank payment system, which is essentially its counterpart to SWIFT. SWIFT is the network that facilitates global money transfers, and the United States exercises substantial influence over it and has employed it as an instrument for enforcing sanctions against other nations. With CIPS, China can transfer funds internationally without relying on networks that Washington can directly monitor or regulate. China has also been vigorously promoting yuan utilization in international commerce. It maintains currency swap agreements with numerous countries. It is establishing yuan clearing centers in major financial hubs worldwide. It is denominating increasing portions of its foreign trade in yuan rather than dollars. And perhaps most critically, it is supporting all of this with gold. China has ranked among the world's premier gold purchasers for years. It does not disclose precise figures, and that is strategically intentional. But all assessments suggest it has accumulated thousands of tons of gold. Why gold? Because gold possesses a characteristic that U.S. Treasury bonds lack. It cannot be frozen, it cannot be sanctioned, and it cannot be conjured at will. It constitutes genuine physical wealth that exists independently of any government's decisions. If tomorrow the United States froze all Chinese dollar assets, that gold would retain its value. It represents the ultimate safeguard against American financial power. Second, the contention that China would damage itself by selling its bonds conflates short-term tactics with long-term strategy. Certainly, if China dumped all its bonds simultaneously, prices would collapse and the value of its own holdings would plummet. It would resemble attempting to sell 100,000 shares of a company instantaneously. You would overwhelm the market and the price would crater. But that is not China's approach. It is selling incrementally, persistently over many years. It is reducing exposure without triggering market panic. It is the distinction between frantically fleeing a burning structure in pandemonium and evacuating in orderly fashion. You achieve the identical outcome, exiting, but with considerably less damage. And here is the deeper reality that many dollar advocates prefer to disregard. China can absorb certain losses on its treasury holdings if that means escaping a substantially greater strategic vulnerability. Consider it this way. If you have $1 million invested in something you believe will ultimately depreciate, would you rather sell now for $800,000 or wait and risk losing considerably more later? China is making the strategic calculation that accepting managed losses today is preferable to remaining fully exposed in the period ahead. But the most significant challenge for the United States is not merely that China is selling securities. The genuine problem is that America requires buyers more urgently than ever. Examine U.S. budget deficits in recent years. They are staggering, trillions of dollars annually. Interest payments on the existing national debt alone now surpass $600 billion yearly. And that figure continues escalating as interest rates climb. America is ensnared in a debt spiral. It must borrow more each year merely to service interest on existing obligations atop funding routine government operations. And if traditional foreign buyers, China, Japan, petroleum exporting nations, are reducing their purchases, then someone else must compensate for that shortfall. So who acquires the bonds when overseas buyers retreat? The Federal Reserve, America's central bank. And when a central bank purchases government debt, there is a technical designation for that: debt monetization. In accessible terms, it means the government is generating currency to finance itself. And this is precisely what occurred during the pandemic. This transpired on a scale never previously witnessed. The Federal Reserve effectively purchased trillions of dollars in Treasury securities. It expanded its balance sheet from under $4 trillion pre-pandemic to exceeding $9 trillion at its apex. That exceeds $5 trillion conjured from nothing and employed to acquire government obligations. And what was the consequence? The most severe inflation in 4 decades. Food prices surged by 20, 30, even 40%. Gasoline prices soared. Housing costs escalated. Real wages declined because salary increases could not match rising prices. Working households suffered while asset owners, those with equities and real estate, grew wealthier because all that money creation propelled asset values upward. This exemplifies what I term the class dimension of monetary policy. When the Fed generates currency, it does not affect everyone uniformly. It disproportionately benefits individuals who possess financial assets. It disadvantages individuals who depend on wages and whose savings lose purchasing power. So when people inquire, why does this matter? Why should you care that China is liquidating treasury bonds? Here is the response. It creates an impossible arithmetic problem for the United States. Either the American government dramatically curtails spending, which is politically implausible, or the Fed continues generating currency to purchase debt that no one else desires. That produces elevated inflation, which means your currency purchases less, which means your standard of living deteriorates. There exists no painless exit from this contradiction. It represents the inevitable consequence of decades of living beyond our means of financing overseas conflicts, with borrowed funds of reducing taxes for the wealthy, while expanding military expenditures, of rescuing financial institutions and major corporations, while permitting infrastructure to decay. This constitutes the long-term toll of those decisions now materializing. And let me be direct about something additional. This is not merely numbers on a spreadsheet. This concerns power. The dollar-based system has served as the foundation of American global hegemony for more than half a century. It has enabled the United States to maintain hundreds of military installations abroad. It has permitted America to impose economic sanctions on countries it opposes by excluding them from the worldwide financial network. It has allowed America to sustain a defense budget exceeding the next 10 nations combined. All of this depends on the privileged status of the dollar. And if that status erodes, the entire architecture of American influence begins trembling. Now, let me address another point I encounter frequently. People observe that China possesses its own challenges. Its property market is distressed. Its population is aging. Its economic growth is decelerating. They suggest China cannot genuinely rival the United States. All of that is accurate. China unquestionably confronts substantial structural difficulties. But this is not about China being flawless or China supplanting the United States. This concerns the world no longer desiring to concentrate all its resources in the dollar basket. It concerns diversification. It concerns possessing options. For the first time in 50 years, nations possess genuine choices regarding where to maintain their reserves, which currency to employ for commerce, and how to shield themselves from financial turbulence. And they are exercising those choices. Consider the expansion of BRICS: Brazil, Russia, India, China, South Africa. And it extends beyond BRICS. Countries worldwide are signing direct exchange agreements to transact in local currencies. Argentina and Brazil trade in their domestic currencies. India and Russia trade in rupees and rubles. China and Saudi Arabia are discussing commerce in yuan. Each of these arrangements is modest individually, but collectively they signify a major trajectory: the gradual migration away from dollar-denominated commerce, and central banks are revealing their preferences through their actions. Data from the International Monetary Fund indicates the dollar's proportion of global reserves has declined from above 70% 2 decades ago to approximately 58% currently. That represents a meaningful reduction. And gold, as previously noted, is being accumulated at record levels. Central banks purchased over 1,000 tons of gold last year alone. They are transferring wealth from American paper assets into physical holdings that cannot be readily frozen or restricted. So the question confronting the United States is fundamental. How do you preserve the dollar's privileged position when the world no longer wishes to confer it so readily? And this is where the options become very constrained and very perilous. Option 1 involves the United States accepting a multi-currency world where the dollar remains relevant but no longer predominant. This would require humility. It would require restructuring global financial institutions to grant developing nations greater representation. It would require accepting limitations on American authority based on historical patterns and contemporary politics. This appears highly improbable. American leadership is not prepared to relinquish this advantage voluntarily. Option 2 involves the United States attempting to compel the world to continue using the dollar through coercion. Additional sanctions, increased pressure on allies, potentially even direct actions to control strategic resources or trade routes. This is hazardous because it transforms an economic transition into geopolitical confrontation. And frankly, based on recent experiences in places like Iraq, Afghanistan, and Libya, this represents an option American policymakers would seriously contemplate. Option 3 involves the United States persisting on its current trajectory, generating more currency to cover deficits, accumulating more debt, and eventually encountering a fiscal crisis where bond market sees interest rates spike and the economy plunges into a severe recession. This constitutes the hard landing scenario, and every year that passes without meaningful reform increases its probability. Option 4, and I consider this the most likely, involves gradual fragmentation. The global system divides into currency blocks. A dollar block led by the United States and its closest partners. A yuan block centered on China and its trading partners, possibly other regional groupings as well. The world becomes more unstable, more unpredictable, more susceptible to friction. But there is no singular catastrophic collapse, merely a steady erosion of the previous order. And this returns us to China liquidating American securities. What China executed was not a singular event. It was a statement. It demonstrated that they possess alternatives, that they are no longer captive to the dollar system, that they can protect their national wealth from what they perceive as reckless monetary policies in Washington. And that statement is being clearly received in capitals worldwide. Other nations are observing this. They observe that China can accomplish this. They observe that existence beyond the dollar is possible. They observe that the perception of absolute American financial dominance may not be as robust as it once appeared. And once that perception propagates, momentum builds upon itself. More nations sell securities, which elevates interest rates. That makes it costlier for the United States to service its debt, which leads to more currency generation, which fuels more inflation, which further undermines confidence in the dollar, which leads to more security sales. It constitutes a destructive spiral, the precise inverse of the virtuous cycle that maintained the dollar at the summit for decades. So, what does all of this signify for you, the ordinary individual watching this? It signifies the world you were raised in, the world where the United States established the rules, where the dollar was supreme, where we could consume more than we produced without apparent consequences, that world is vanishing, and that will have tangible effects on your daily existence. If the dollar depreciates, imported goods become more expensive. That means elevated prices for virtually everything from electronics to apparel to groceries. If the United States must pay higher interest on its debt, there is reduced funding for everything else: education, transportation infrastructure, social programs. If we encounter a fiscal crisis, we could witness dramatic cuts to programs that millions of citizens depend upon. If the global economy fragments, you may experience supply chain disruptions, merchandise shortages, and job losses in industries connected to international trade. None of this is distant. None of this is purely theoretical. This affects your capacity to afford rent, to purchase food, to plan for the future. And what troubles me most is that none of this was unforeseeable. Critical economists like myself have been warning about these contradictions for decades. We have been emphasizing that you cannot finance an empire with borrowed capital forever. We have been highlighting that the dollar's privileged status was generating complacency, that it was allowing policymakers to evade difficult decisions, that it was masking underlying weaknesses in the American economy. And now those underlying weaknesses are becoming exposed. China has recorded a record trade surplus of nearly $1.2 trillion in 2025, with exporters pivoting toward Southeast Asia, Africa, and Latin America to offset American tariffs. The shift is accelerating. This is not about assigning blame to China or any other nation. This concerns recognizing that the structures that have governed the global economy since the Second World War are transforming. The dollar's dominance was never permanent. It was a historical circumstance that emerged from specific conditions: American industrial supremacy after the war, the Bretton Woods Agreement, the petrodollar deal. Those conditions have shifted, the world has altered, and the United States has failed to adapt. What we are witnessing now represents the consequences of that failure to adapt. It represents the price of decades of excessive spending, of prioritizing short-term political gains over long-term economic sustainability, of treating the dollar's special status as an entitlement rather than a responsibility. And whether you are prepared for it or not, that price is coming due.